Coming up today, tech stocks lead the market higher. Nvidia closing in on a record. Brace for more volatility. The latest from Hurricane Milton. A trader loses $306 million on Tesla. What did Chinese authorities just do? And did China stocks just crash, or is this another buy the dip opportunity? It's going to be a good one, guys. Let's go. And welcome back, everybody, to the Daily Market Review. Thanks for tuning in with me today on what is yet again another interesting day across financial markets as usual. S&P 500 pushing up to all-time highs, 57.51, led by tech shares today. Nasdaq up 1.5%, as we've got Nvidia pushing up towards all-time highs as well, just overtaking Microsoft. Now the second largest stock in the market, just behind Apple. And stick with me today, because I'll let you know what's going on with Nvidia, and I'll share with you the interesting story of how a carpenter turned $65,000 into over 300 million trading Tesla options, only to lose it all. I think you'll find that really interesting. But first off, let's talk about the elephant in the room, or should I say the dragon, something I've been covering a lot this entire year. Chinese shares. Seen a lot of people across social media today claiming China's crashed, people commenting on my videos, saying I told you so. They're uninvestable, down 10% is crazy. However, in my opinion, this is not a crash. This is just a pullback, like we'd been expecting. And so first off, I understand there's many people still new to trading or they're inexperienced. So I'm not here to try and belittle anyone, but rather educate, as there's clearly a need out there too. And to be honest, sometimes I don't know if I'm talking to a 20-year-old crypto trading kid in his mum's basement or a 50-year-old whiskey drinking man. So I'll give them the benefit of the doubt. However, you have to understand in financial markets, everything is relative. And the reason why I don't call this a crash is because a 9% pullback in Chinese shares isn't the same thing as a 9% down day in the S&P 500, especially this month. Just like a 9% down day isn't the same thing in bonds or gold. There's no single yardstick to measure performance across all assets around the world. Now, I understand why people see negative 10%, and they're used to seeing that in American stocks or other developed economies, and that would be a big down day, no doubt. However, like I said, in my opinion, it's just a pullback, and one that we expected, and we're literally only trading back at last Tuesday's level. In fact, we closed above last Tuesday's high, so we didn't even take out weekly lows. In fact, I was expecting a bit of a pullback last Monday. We're still trading above that level. We didn't even touch the 50-day volume weighted average today. And I mean, when's the last time you saw S&P 500 rocket up 48% in 1 month? Like I said, you just can't compare the two. But I understand this is a lot of volatility for some people to deal with. But in my mind, it's no big deal, because relatively speaking, it's kind of the same thing as S&P 500 having a 2% down day, which again, is no big deal. In fact, my stock picks portfolio that actually holds Chinese shares as ADRs listed in New York actually finished in the green today, as my Chinese stocks were only down between 2-4%. Plus my portfolio is very diversified. In fact, my first stock pick from June is now up over 70% since I first bought it, after it rallied another 6.5% today. But just getting back to Chinese shares, and stick with me today, because I'll explain to you in a minute what actually caused this sharp pullback today, and where I think we go from here, how much further we could have to retrace, and whether I think this is a buy the dip opportunity or not, and what else us investors have to look out for. So just keep in mind, Chinese stocks are not your grandma's bonds. They're going to move around a little bit. And like I said, I know plenty of you guys are smart and experienced traders who follow me. I'm seeing a lot of people on social media that have obviously chased this rally, a little bit of Johnny come lately, and then they've been spooked out on this sharp pullback today, not to mention all the fear a lot of financial influencers are promoting out there. But just think for a minute how stupid that is. If you were buying up here after it went up almost 50% in the month, everyone and their dog knew about it, and then on the first little pullback, you get spooked out and sell it. Anyone who's doing that sort of stuff is literally the patsy of the stock market. And anybody who thinks this is a crash, they shouldn't be trading stocks, especially Chinese shares. They should stick to bonds, and probably short-term bonds as well, so they don't take on too much duration risk. Also, keep in mind the same people screaming Chinese crash today were literally the exact same people that told you back at the lows China was uninvestable, which we've already rallied up 70% from. So like I always say, volatility is the currency we pay with for outperformance. And the fact is, China is still the best performing stock market year to date. Even after today's so-called crash, it's still up 38% year to date, almost double the S&P 500, which is also having its best year-to-date performance in a typically bullish election year too. So like I told someone this morning, just calm down, it's no big deal, it's to be expected. I've been saying this with Chinese shares and tiger brokers, to expect a pullback, a lot of volatility. These big fat green candles are not just going to print forever, and we're so stretched in the short term, we're so overbought and crazy. Like I said, one of the biggest monster rotations I've ever seen. We were due a pullback, and just looking at the 5-minute chart on Tiger Brokers this morning, when it was dipping down to the low 8s early in pre-market, 4 a.m. New York time, we bounced back up, finished at 950, and so even though the stock's down 16% today, the business didn't change by 16% overnight, nor did its revenue, nor did its book value. In fact, in my opinion, the fundamentals are still way better than a month or two ago. And I actually hope it keeps going down in the short term because in my opinion, for me, it would be another opportunity to buy the dip in the low 8s. Who knows, maybe even 7 and 6s. I hope I get that opportunity because I like the business and plan on holding it for longer than 2 minutes. So like I always say, if you know what you got, then you see stock prices differently. Instead of becoming beholden to them, you can take advantage of them. And like I've also said, most bulls will get shaken out of China because they're too sensitive to withstand a 30 to 40% correction without getting the crap scared out of them. And even worse than the paper-handed bulls are the fearmongers who are convincing millions of people to run away from potentially one of the greatest opportunities of our lifetimes. And don't get me wrong, there are unique risks to investing in China. Like I said, if they go into Taiwan, that's probably the biggest one. And nothing is guaranteed. Like I always said, even if all their stimulus works, it's not going to be a walk in the park. There's going to be plenty of corrections, pullbacks, consolidations, and that'll shake out most of the bull. And this is just why diversification is the most important thing in investing. And there's a look at Alibaba. Like I said, we're still 12% above our 50-day volume weighted average. So people out there screaming China crash, I mean, it's just kind of comical in my opinion. But anyway, that's the market, and I guess that's what creates opportunities for us investors as well. But like most of those people out there just calling crash because they're drunk on the chart and they can't see anything else than the latest candle right in front of them, just looking underneath the hood at what's actually going on, the nitty-gritty details, fundamentals. Why we got that sharp pullback today is because we were coming in so hot, so stretched in the short term. Expectations were flying. Market was expecting massive stimulus from the government, fiscal stimulus, big government spending package, and they really underwhelmed today, holding off on a big fiscal stimulus package, in which their scheduled announcement after their national markets just opened back up after their holiday pretty much just reiterated they're committed to 5% GDP growth. They did come out with a package, but it was super small, like only $30 billion US. All the market was hoping for something big, 400 or 500 billion. But just looking at some reactions and commentary from Chinese analysts, I agree with this guy here that they may have made a disappointment announcement on purpose, fearing the market bubble was forming right before our eyes. The frenzy of new investors opening brokerage accounts would have set off alarm bells in Beijing, so they may have nipped it in the bud, which I agree with. You got to remember with the Chinese government, their number one mandate is to stay in power, and to do that they need social stability, economic stability. And so they don't want their markets going vertical in either direction, because that inevitably creates a lot of volatility. If they came out with a bazooka-sized stimulus package today, sent Chinese shares up another 20%, then we're just setting up for even a bigger pullback, or what some people call a crash. So even the reporters at this announcement was like, is there anything specific you can announce? And they were just giving out generalities. In other words, they're still keeping this big fiscal package card up their sleeve, still keeping some dry powder and allowing their markets to pull back, and purposely came out with an underwhelming announcement. We've already seen record rotation and rally in Chinese stocks. We're getting so vertical, like I said, we were due a pullback. But again, you can get drunk on the latest candle and base all your financial decisions off that, or you can keep your eye on the data and know what you've got. Just looking at some data from their national holiday, passenger trips rose 3% year over year, and it was actually 23% higher from 2019 during their holiday period. Now the consensus out there is the Chinese economy is cooked. It's going to be the first developed economy pretty much in history to never bounce back. It's going to be locked in this perpetual depression, and the gap between their actual economy and their capital markets will never close. Got to remember, the stock market's a forward-looking mechanism, prices in the future, and again, we're getting more data. Transactions on WeChat Pay up 20% year over year during the first 4 days of their national holiday period. Not only that, all the millions of new trading accounts that have been opened over there can't actually start trading until later on today in Asian session, Wednesday the 9th. So the Chinese authorities knew that. They didn't want to run their stock market to the moon whilst all these retail traders are just starting to get in. And like the chief economist at Standard Chartered in Hong Kong said, even though they didn't announce fiscal stimulus today, that doesn't mean there won't be fiscal stimulus. And it's clearly the markets are demanding that. Goldman Sachs came out with a piece yesterday, said they've got to do quantitative easing. They really want to get underneath that. So believe it or not, they know all that. They understand all that. And what do you think is going to happen if millions of new Chinese retail investors get into the market and for some reason, and this is possible because anything can happen in the market, we do get a crash, which I would call taking out all these gains, down 20 or 30% would be a crash for China. What do you think the Chinese government is going to do the very next day? You guessed it, a massive fiscal package. Then back up we go. But like I said, a lot of what I'm seeing across social media, people just can't handle seeing a stock market down 10% in one day. It's just too much volatility, which is true if you have your whole portfolio in it. But if you've diversified and it's just a couple of positions, then it's really no big deal. And I'm not just talking about small retail traders either. Big, large institutional traders, hedge funds, the fear is real. And this has been going on for a couple of years. Saw record capital outflows. A lot of investors just given up on it. Too much pain for too long. But it's from these levels of maximum fear we can get maximum returns. And like I said, there are risks in China. But to me, even if it's a coin flip, I see it as heads I'll lose $1, tails I make $3, $4, maybe $5. And that is a bet I'll take every time. Because if you take enough of those bets, you inevitably end up on top. And so no doubt, if this China trade doesn't work out over the next year, 2 or 3, I'll be swamped in messages that they all told me so. However, in my mind, it's just another trade. It didn't work out. No big deal, move on. But this post on X today sums up the mood pretty well. FinTwit, which is short for financial Twitter. Alibaba after 50% move up, China is investable again. Alibaba after an 8% move down, I told you China was uninvestable. I literally had someone tell that to me today. So once again, just to be clear, I expect a lot of volatility with Chinese shares. For sure, we could keep pulling back to the 50-day VWAP. Who knows, may even get a sharp spike down. But if we do get that, you can bet your bottom declining dollar that I'll be right there buying the dip. And I consider that a great opportunity. Because like I said, the Chinese government is going to keep stimulating until they turn this thing around. Anyway, like I said, that's just one trade in my portfolio. Moving on today to where likely some of that hot money coming out of Chinese shares is going to. Nvidia, rallying up as they make their way through the AI summit in Washington, D.C. We're also on the cusp of them releasing their new Blackwell chip, which Jensen Huang said demand's off the charts. Got billionaires jumping over each other, trying to cuddle up to him to get first in line, buying up as much GPU chips as they possibly can. Now also touching on things today at their summit, game-changing energy efficiency and AI-driven innovation, that their Blackwell platform has achieved groundbreaking energy efficiency, reducing energy consumption by up to 2,000 times over the past decade, training models like GPT-4. Also heard a few other things that they announced today. They've partnered with a number of companies, some astrologists that are searching for extraterrestrial intelligence. Sounds pretty cool. Collaboration with some universities. Nvidia also said US healthcare system is adopting digital health agents to harness AI across the board. Nvidia's blueprint for cybersecurity and more developments with their CUDA data processing platform. So as you can see, it's quite wide-reaching technology, pretty much touching every industry out there can benefit from Nvidia product along with AI app. And in fact, if the estimates hold up, global data center demand will more than triple by 2030, compounding at an annual growth rate of 19%, which I would agree with. We'd need a really big recession, in my opinion, to kind of change materially these growth estimates. Because like Isaac Newton once said, an object in motion tends to stay in motion, and we have got a lot of momentum in the demand for data, AI, electricity. This thing's already underway, and in my opinion, it's showing no signs of slowing down unless we get a real big economic recession. However, recessions pretty much only last 6-18 months. So maybe a soft year or two, but then no doubt it'll bounce back because there's just so much efficiencies to be had with AI. It's simply undeniable. And that's what I'd been pointing to last week, because back then we had a lot of bullish seasonality coming into the stock. And along with this AI summit, and we've still got bullish seasonality here, we very well may break out to new all-time highs, and the AI semi-chip trade is back in full swing. Not only that, we've just kicked off Q3 earnings season. Analysts are expecting S&P 500 will post a 4.1% year-over-year earnings per share growth, with sales growth of 4.7%. So if the actual results, by the time we get halfway through, the market would already sniffed out the trend. That could play into how the market trades from here, but we've just got so many things happening at this point of time. Potentially a changing narrative from worries about the jobs market to worries about inflation. Pretty much a full-blown war in the Middle East. Federal election quickly approaching, just a couple of weeks away now. Hurricane Milton, there's a lot that can move markets around over the coming days and weeks. We just heard from Pepsi, kind of the first biggest stock to kick off Q3 earnings. Posted earnings per share $2.31, slightly above analyst expectations, but they did trim their full year outlook and actually saying consumers are dialing back the soda and sugary snacks. And that's a bit of a secular trend with Ozempic as well. Something that's been going on for over a year that we've seen not only in Pepsi, but a lot of snack makers. Pepsi's actually held up one of the best. And this prolonged sideways action certainly makes for good swing trading. Nonetheless, the stock still finished up today. However, if you look at some of the biggest snack makers in the world, Nestle amongst them, still trading really weak. And this has been going on for a couple of years. And like I said, who's been eating their lunch is the Ozempic weight loss drug producers. Eli Lilly, all those companies' losses have turned into their gain as those consumers have gone from eating sugary snacks to taking weight loss pills. They don't need those snacks in between meals. But we are definitely coming into this earnings season and fourth quarter pretty hot. S&P up about 20% year to date. Best election year performance year to date. Looking back in history, as we're now 2 years into this bull market off the October 2022 lows. Most bull markets do make it to year 3. It's only a couple of times in the past that they haven't, and those losses weren't that big either. And the bull market is still young. Average bull market goes for 5.5 years. However, there have been a few times where it's only gone a little bit longer, back in the late 60s, early 70s. And in fact, the COVID bounce was a little less than 2 years as well. But like I've been saying, the S&P 500 on a long-term chart is really stretched. Even if I change it to logarithmic, which you should always do, especially when looking at more than 20 years of data, still looks stretched. In fact, this is really rare to see 5 of my reversal signals fire off on a yearly chart of any asset, and just how different the Chinese stock market look on the yearly chart as well. Still well below those 2007 highs, even though their economy's multiplied since then. Massive divergence between their economy and their stock market. And like I said, this is the month where we typically see stuff happen, October. We just got a hot jobs report last Friday, kind of making us all scratch our heads. Why exactly did Jay Powell cut 50 basis points? Thought the jobs market was just about to get soft. Now we got inflation data coming this Thursday, which I'd be very surprised if it did come in hotter than expected, especially at this point of time. Say the powers that be want to keep everything running smoothly. Certainly don't need markets crashing as Americans begin to cast their votes. There's a look at Wall Street Bank's estimates of what headline and core CPI will be come this Thursday. And we'll be paying attention to core CPI year over year, 3.2%. And like I've been saying, it's just comical. We've still got core inflation on a 3 handle. And we've just been sitting here last week talking about the Fed maybe doing another 50 basis point cut with the stock market and property market at all-time highs. And that's why the bond market kind of changing its tune as well. You can almost say the market and some politicians pretty much just walked Jay right into a big cut. He had so much pressure coming from everywhere. Subconsciously, he probably just didn't want to deal with all the blowback if he only went 25 basis points. Certainly would have caused a lot of volatility in the market that had priced it in. Not to mention senators like Elizabeth Warren would be very upset at him after she sent him a demanding letter, actually asking for a 75 basis point cut. However, according to this article, stock investors shouldn't worry about the 10-year treasury yield ruining this year's rally, saying it'd need to climb to about 4.5% before that could happen. Be very surprised if we saw 4.5% by Christmas, but who knows? If we do get some hot inflation, anything's possible. Yields would definitely spike back up because that whole narrative that inflation is over would flip on its head. And there's a look at the 10-year, just holding the 4 handle today. The 2-year still a little lower, so we may consolidate around this level for a while. Maybe pull back, retrace, but I'd say the risks still remain to the upside with inflation now. China stimulus, loose Fed, expanding economy, the wealth effect from stocks at all-time highs. That should keep bond yields bid. We are a little technically oversold in bonds as well. We may consolidate here for a little bit. And there's a look at high-yield bonds, still holding their uptrend. No real panic in credit markets at this point in time. Now over to Hurricane Milton, which is set to be a doozy. Just got a post on X today from a meteorologist in Orlando. So this is nothing short of astronomical. I'm at a loss for words to meteorologically describe to you the pressure and max winds, getting up to gusts of 225 miles per hour. That is crazy. This is now the second strongest hurricane ever recorded by pressure on this side of the world. This hurricane is nearing the mathematical limit of what Earth's atmosphere can produce, so it is a monster. Set to make landfall over the next 24 hours. It's going to have widespread effects for businesses and citizens in Florida, potentially all across the country, knocking out electricity, leaving power plants idling, big claims for insurance companies. No doubt a lot of home improvement and repairs will need to take place over the coming weeks and months. Apparently, we already got 16% of stations in Florida out of fuel, with 43% of gas stations in Tampa and St. Petersburg out of fuel as well. Got a frenzy of evacuations from Florida expected to make landfall Wednesday evening. And so like I said, this could have ripple effects to not only those in Florida, but all across the country. Article on Barron's saying even GDP could take a hit. The October jobs report is likely to be significantly affected. So in other words, the jobs report in November that we get out on the first Friday of every month will certainly be an interesting one, because the first Friday of November actually falls on the 1st. Got the federal election on the 5th. What's the Bureau of Labor Statistics going to give to us in a jobs report a few days ahead of the election? And whilst we certainly wish the best for everyone in Florida, I hope you guys make it through. Just on a more lighthearted note, some memes posted across X today. From not Jerome Powell, Florida changes name to Ukraine to receive faster aid from the government. And another one from the Babylon Bee, popular parody account. Zelensky asks if this is a bad time to maybe get a couple more billion. Maybe not, right? And that's because the government's already breaking record on their spending, deficits and debt. Federal deficit Difference between what the government receives in revenue and what they spend hit 1.8 trillion in 2024. In all, the government collected 4.92 trillion in revenue and spent 6.75 trillion in the year that ended September 30. So to put that into some context that we can understand, if you're a high income earner and making $492,000 a year, for how long do you think you could sustain spending $675,000 a year? It's just simply not sustainable. And that's been the trend over these last 4 years. Spending's just blowing out. And just moving on to the situation in the Middle East, just looking at a photo here of a man standing in Israel as Hezbollah continues to launch a barrage of rockets into northern Israel, hitting city suburbs, which Israel is responding to by expanding their ground offensive in Lebanon. Hezbollah launched more than 100 rockets into northern Israel on Tuesday, hitting a suburb, and we're still waiting for Israel's response to Iran. They're still trying to work out what assets of theirs to target, and I'm pretty sure they won't be going for suburbs in Iran either. Iran said they're ready, fully prepared for a massive war. Some say they already have a nuke. There's been reports they may have already tested it, but we're also getting reports that Israel may not target their nuclear sites. Apparently, the US administration's asked them not to. We're now getting word that Israel may be considering striking energy facility, which I'm not too sure how much truth that holds either. Remember, we're all speculating at this point in time. Everything I say in my videos is my opinion only. And why in my opinion I don't think they're going to go for their oil facilities is A, price action in crude today was also a sharp pullback. After it had been rallying up, pricing in that potential, I don't think they'll attack the oil facilities because that'll just spike the price of oil, which will upset all of Israel's alliances. In my mind, they're better off taking out their nuclear facilities and de-risking from that potential. However, they may just go for their military assets and their ability to launch more missiles, stuff like that. But like I've also been saying, expect a lot of volatility in crude, up or down, which we can actually see in oil options today as well. Looking at the oil VIX, at a healthy 52, market is still on edge. But just looking back at history from some research from Bank of America, and I know this chart's a little blurry, but basically it shows what are the best geopolitical hedges, looking at previous events. Well, ever since gold futures started trading, it's been a clear winner. 3 months out, up 8.3%. However, 6 months out, it's gold. It's hard assets that often make the best hedges for inflation and war. And looking back in history, government bonds, especially long-dated bonds, typically spiked in moments of fear and panic. However, the last couple of years, not so much. I think it's a bit of an ongoing changing dynamic in the treasury market. And just speaking of gold, we just got some research coming out from Goldman Sachs saying that even though gold's at $26.50 US, Aussie gold miners are barely pricing in US 1900, saying that they've been valued at gold, sitting over $700 below current gold price. Goldman putting faith in mid-tier Australian goldies as valuations trail record spot price. Bellevue Gold, Gold Road Resources, and D-Gray Mining. And that's why I always say there's a lot of great opportunities out there if you can cast a wide net. The commodity countries of Australia, Canada, Brazil, a few others are full of opportunity. We just even heard from one of the largest iron ore miners in the world, Rio Tinto, now joining the top 3 lithium miners with its Arcadium acquisition, which is interesting to see a big mining company like Rio making big moves into lithium. There's a look at the stock price of Rio today. The materials also pulling back on China. Bit of correlation there. Maybe helped to pull oil back a bit too as well today with China pulling back. And there's Arcadium Lithium popping up on the takeover. And just looking at the global lithium and battery technology ETF, that has been on an absolute tear along with China this last month. Didn't even really pull back that much today, just down 4.2%. And lithium is another commodity I'm bullish on long term as the world gets electrified. So that, along with gold, silver, uranium, copper, nickel, and lithium, they're all metals and minerals of the future. For the AI boom, clean energy, electronics, you name it. All these commodities are really important. And as promised earlier in this video, sharing the story with you of the Tesla trader who turned $65,000 into $306 million before losing it all. The Canadian trader, who's a carpenter by day, successfully traded Tesla stock and options during the COVID pandemic when a record amount of stimulus helped stocks soar and drove a retail trading boom. He had about $65,000 with a Canadian brokerage. At its peak in November 21, turned into about $306 million US. That's incredible. He must have just been buying the dip and Tesla call options and just pyramiding his size more and more. However, he claims his broker neglected him, gave him inadequate advice, didn't realize he was an amateur investor, was also given advice to donate over $25 million to lower his tax liability. Some things these bankers do, right? However, this is still an ongoing thing. We don't know whether he's going to win this lawsuit or not, and I'll come back to this in the future and see how he's gone. I would imagine a company like Royal Bank of Canada would just settle outside of court for a couple of million or something just to shut him up. Highly doubt he's going to get anything back close to $300 million, but it just goes to show you what a wild ride it was Tesla in late 2019. It's a real humming Tesla community. Millions of bears saying it deserves to be a penny stock. Just added fuel for an explosive move to the upside. It's kept rallying and rallying. Sharp correction in COVID. Stock lost over 50%, a bit over a month. My indicators nailed the low and then it bounced back up and just went on a super parabolic tear after we already just had one coming into the COVID, even more so going into late 2020, then into 2021. And just when you thought it'd gone crazy and had put in a top, said it's all over, nope, just kept on going and went even higher again. And then that's when it put in a top that we haven't come back to since. We rolled over, went into a bit of a bear market, super low, was hated, punished. But like I said back here, just after I started my channel, we were getting bullish signs, accumulation from big money, valuation was super cheap. In fact, my stock fair value indicator had it at over $180 a share fair value back when it was trading down into the low 100. All that volume that you typically see with the bottom, and I'm sure a few of you remember how hated Tesla was down here. We even had people coming out on CNBC saying they're short the stock, it's going to $40. There's always good reason to be afraid and sell. But one thing you can bet on is change. Things don't remain the same forever. And so that was a cheap level. And we've a bit more than doubled since then. We have been consolidating a bit over a year now. As Tesla's still been under a lot of pressure from consumers and high interest rates and the flood of EVs from China. And so it's not exactly cheap, as you can see in my indicator. I think it does deserve a 30-40% premium. However, because we've been lacking growth, my stock fair value is just not too keen on it. And at 780 billion market cap, I agree. It's not exactly cheap. We really need to see some growth come back for my stock fair value to start climbing again. And so if you'd like to get my stock fair value indicator, plus all 28 of my custom indicators for TradingView, and click the link below this video, because for just a few more days only, I'm offering 50% off a yearly plan. And you can get all the indicators and chart layouts you see me use in these videos every day. And that comes with dozens of video tutorials as well to teach you how to use all my indicators. I also send out a monthly newsletter to indicator members where I perform technical analysis on key markets using my custom indicators. So if you're interested in taking advantage of that deal, head on over to clickcapital.io and use coupon code TIGR. And there's the economic calendar today. Not a whole lot out. Still getting a few Fed speakers this week. Whole bunch tomorrow. And then Thursday's the big one. Inflation data. 3.2% year over year is what's expected. And we'll see how that plays into Fed fund futures. Currently 86% chance Fed's going to trim 25 basis points in a little less than 4 weeks from now. And there's a look at the VIX, just pulling back a little bit today, 21.4, still a little elevated here. Bitcoin still hovering around 62,000 a coin. And that's pretty much a wrap for the daily market review. Thanks for tuning in, and we'll see what tomorrow brings us. Cheers.